Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site is Vinay Shandal, Managing Director and Senior Partner at BCG, William Theisen, CEO of EcoAct North America, Matt Chris, Portfolio Manager with Emerging Markets Transition Debt Strategy at 91, and Mary Ellen Iskenderian, CEO of Women's World Banking. We're here to discuss the nuances capital allocators consider when deploying funds to climate tech investments. It is great to have all of you with us, certainly an important topic. We have New York City Climate Week coming up just next week. So let's go around the horn here quickly. Vinay, we'll kick off with you. Quick elevator pitch. Tell us the work that you're doing at BCG.
Yeah, focus for me is lead the North American climate practice. So two parts of that. One is we're helping the largest companies and governments think through how to decarbonize emissions. And related to that, helping capital and innovators scale climate technologies that we need for the transition.
Right, and Matt, William, remind us of EcoAct.
So over at EcoAct, we're a climate consultancy and also a carbon offset retailer and project developer. So we're working with companies to see how they can measure their emissions, set science-based targets, reduce, assess climate risk. But on the other side, we're actually working with companies to actually procure carbon offsets on the market, in the voluntary carbon market. And also, we're a project developer, so we've developed projects like improved cook stove projects, forestry projects in the past, and we have about 15 projects in our portfolio supporting innovative technologies utilizing carbon finance.
Right, and Matt, tell us about 91. Is there significance to that number?
Yes, there is. So 91 is an active investment manager. Today we manage around $162 billion in AUM. We were founded in 1991 in South Africa, and so I think that emerging market heritage is something that's very unique for us, and it also forms the way in which we look at the global energy transition towards net zero. The strategy that I'm involved with makes public and private and infrastructure debt investments in emerging market companies and projects that are facilitating the decarbonization of emerging markets.
Right, and Mary Ellen, Women's World Banking.
Yeah, so we're also in the emerging markets. We are a global NGO and impact investor that are focused on the nearly 1 billion women who are completely excluded from the formal financial sector, and as a result have way less opportunity for resilience or adaptation or risk mitigation from climate.
Why do you think there is financial inclusion when it comes to the over, billion women in the world that are associated with this? And what about climate vulnerability? It's almost like once the wheel starts spinning, it's spinning when you add in the variable of climate.
Yeah, no, you're spot on. A woman is 14 times more likely to die of a climate disaster than a man is. And we just recently did some interesting work looking at the overlay of climate vulnerability and financial exclusion. 753 million women around the world are completely excluded from financial systems. We saw during COVID, one of the biggest problems were women didn't have access to payment mechanisms, digital, they didn't even have cell phones. 880 million women in climate vulnerable countries, can't be found to receive a relief payment. So it's these two crises are really, really interlinked.
Yeah, which to me is amazing because that's how you grow local economies, right? That's what this is all about. So, Matt, let's address some of these challenges when securing capital to climate tech investments. It's capital intensive, it takes time. You have the regulatory mandates, which are pretty aggressive. So, it's a challenging investment to make.
It is, and I think the first thing that pops into my mind in terms of addressing those challenges is, can you deliver to investors a commercially attractive risk-adjusted return? So whether it's impact or not, investors are demanding that, as they should, right? The next thing that comes to mind is, when you're talking about impact, how are you quantifying that impact, and are you being transparent with the asset owners that have invested with you in terms of how you are progressing on your impact goals? You've made a certain promise, a certain commitment. Is it quantitative enough that you can be held accountable to how you're performing vis-a-vis those goals? Mm-hmm. The last thing that we're seeing more and more of is people are really interested in real-world decarbonization. So not about portfolio divestment or portfolio exclusion, not about making a greener portfolio, but rather, what are you doing in the real world to drive us all towards net zero? And in emerging markets, more and more that's in the industrial space, so decarbonizing critical but hard to abate industries, in green infrastructure, and in new technology and new solutions.
Yeah, and William, you and I have spoken about this before, trying to understand what are the KPIs, number one. Number two, removing the subjectivity, how do you put standardization around, quantifying these investments that you've made?
So hey, there's a lot of standards out there. So I mean, and actually there's more standards coming into the mainstream. So when you're looking at different technologies, whether it be renewable energy, so wind and solar, where you're looking at afforestation projects or even more innovative projects, how do you quantify the actual emissions that that project is reducing? And so the carbon finance mechanism is results-based. It's looking at and it's applying these methodologies that have been developed by these standards, such as the gold standard in Verra, so that companies can be assured that when they're offsetting their emissions with carbon offsets, they're offsetting 1 ton to 1 ton of emission that's actually being reduced thanks to these innovative technologies. But it really has been, going back to what Matt was talking about, trying to mainstream these technologies like wind and solar 10 years ago. Carbon finance really played a key role in that. Now it's trying to mainstream more innovative technologies like carbon capture. So trying to make sure that they're getting the financing so that they can get off the ground, be more profitable, but also have access to more mainstream financing mechanisms like private equity or loans.
Vinay, let's talk about that for a moment here. It's not as simple as issuing a bond and a project is built. I mean, there are so many factors that go into it, never mind permitting and regulatory, but trillions of dollars to achieve these types of goals. Who is financing this?
Yeah. So, not enough people.
Right.
Is the answer, right? Like the annual need in the market to drive the transition 2050 is 3 to 5 trillion. We're getting about 1/6 of that flowing. The good news, though, is I think the conversation has evolved. We've gone from the high level meta, we have a climate problem, to the more micro, we have a low carbon heat problem or a transportation problem, to a solution-oriented conversation, which is we need to scale hydrogen everywhere and fast. And so there's now recognition that we need capital to do the things to make hydrogen available everywhere. Like what? Like large-scale infra investment, which is green energy, new pipe, 40x capacity for hydrogen pipelines, storage. We need capacity production, electrolyzers, the thing that turns water into hydrogen. We need a massive increase in that. And then we need innovation, because to make an electrolyzer, you need iridium. There's not enough iridium in the world, so you need to now innovate to create electrolyzers that don't require iridium. So as these problems get broken down into their component parts, the type of capital that kind of component resonates with, be it infrastructure or venture, can begin approaching those problems in a more concrete way. The issue, though, is the reason the capital isn't flowing enough is, number one, the economics. Is there end market demand? Is there enough policy support? And then number two, are the investors, yourself excluded, but most investors have not built up the muscle, the confidence, the conviction to underwrite the new type of risk. Venture with capital intensity, infra without offtakes. These types of muscles are underdeveloped for a lot of the existing infrastructure investors or venture investors, and so it's helping that ecosystem shift towards taking on more risk.
Do you think perhaps, William, that it was just around having a green portfolio and not necessarily looking at the other offshoots of it and how economies can evolve with investing in climate tech?
I think it's really kind of focused on trying to get all of our energy going in the right direction, right? Like we have all of these kind of solutions out there, but it's about having the portfolio take off of solutions and trying to mainstream as much as possible so it can access and doesn't fall behind in terms of getting that investment that it's needed to really kind of get off the ground and really build and get to scale. So I don't think it's about just like focusing on one technology is like the be all and end all of what's going to solve the climate problem. It's really looking at all of the portfolio of solutions that are adapted to each of the different countries within where they're being deployed, and making sure that those technologies, there's a focus on them, and there's finance that's going to be kind of funneled in there so they can get them to scale and really kind of mitigate and reduce the emissions that are happening within those different countries and adapted to their individual contexts.
So Matt, would you say that emerging markets has the largest opportunity then?
Well, it has a big problem. We could start with that. We talked about the scope of the issue, right? Emerging markets are over 60% of the world's emissions today. What's more concerning is that they're on a trajectory to represent 90% of the world's emissions growth to 2030. About $1 trillion a year, excluding China, needs to go into emerging markets. And there's only about $150 billion that's earmarked for that purpose. So there's this $850 billion financing gap to decarbonize emerging markets every year until 2050. And so when we're looking in that opportunity set, the good news is it's a total addressable market for an investor like us, right? It's a big market, lots of renewable energy projects, decarbonizing grids is super important for so many of the industries that are around there. Decarbonizing heavy industry, right? So if you look at where steel, cement, chemicals, plastics, all of those things that are critical but really challenging to abate from a carbon perspective, where they're produced, it's in emerging markets. So if they've rotated out of developed markets, we still use it here, but we don't produce it as much here. So capital going into those places is necessary as well, in addition to critical minerals, critical mining activities, and focusing on those companies that are providing copper, lithium, metallic silicone for solar panels, things like that. Very important for the U.S. Value chain with respect to the Inflation Reduction Act. So all of that is interwoven into the emerging market landscape. So it's critical not only to decarbonize EMs for their own sake, but also for how it links to developed markets.
And of course, it's also a security issue as well.
Yeah, exactly. And also, I think that this is where the international treaties really kind of play a part, like the Paris Agreement, the Kyoto Protocol back in the day, right? Like opening up these financing, because as you're saying, the 60% of the emissions are coming from the developing nations. But in order for them to have the financing to actually invest into actually not having the 60% overall, but actually developing in a clean way, you have to open up those avenues for more developed nations like the US, Canada, France, the European Union, to actually help finance those emission reduction projects or projects that are going to help mainstream things like carbon capture. If you don't have those mechanisms in place or those trees in place, then it just kind of gets stuck into incremental change.
Yeah.
But there's some ways that we just need to get out of our way. We're an investor in a vehicle company in India that had found, all on its own, that women were 3 times as likely to want the EV two-wheeler than men were. But when we looked at their lending algorithm to men versus women, they had a much higher rejection rate of women. The algorithm, the data that they were using to evaluate the women's credit was basically rejecting credit-worthy women because it was using cell phone data. Women are 30% less likely to own a cell phone in India, so they were using bad data. So it's like there's a sort of built-in biases that if we could just get out of our way, I think there could be some very, very mainstream things done to get more adaptation technology into women's
And that's something that a lot of fintech companies have provided, certainly in the US and Western nations, where you're looking at more holistic credit worthiness, if you will. But Mary Ellen, I want to look at emerging markets in a different perspective here. So we're sitting here in New York. It's UN week. We have climate week next week. It feels like everybody is here. So okay, well, what does that mean about climate tech, right? However, we're trying to work on finding solutions for supply chain security, water scarcity, food scarcity, right? To your points that emerging markets have significant needs for. So is it looking at it from a different perspective and not necessarily that headline that everyone has private jets here, like explaining these investments in a different way?
No, I love that you're putting that different light on things because, we're a financial inclusion organization, but financial inclusion was never the end goal. Just getting somebody a bank account was never what this was about.
Right.
But it always has been about getting them food security, getting them access to water, clearing the brush away from women's ability to get credit for their businesses. Insurance, there's less than 1% penetration of insurance amongst most countries in the emerging markets, and I don't even know what it would be for women. We've seen some very interesting sort of green shoots, an extreme heat insurance product in India with one of our partners there. Unfortunately, it triggers at 42 degrees centigrade, and there's still a lot of stuff that can happen.
That's pretty hot.
It's really hot.
So, trying to do the math.
How do you live between 40 and 42 degrees and make a living? So there's work to be done, but there's also so much opportunity for financial services in these countries.
Absolutely.
Yeah. So Vinay, when you think about allocating capital to certain projects, are there regions or projects or areas that you find more attractive than others?
Yeah, look, I'm excited about a lot of the value chains. I just want to come back to this point about adoption of some of these technologies, if I can quickly, Jill.
Of course.
We take India as an example. We're talking a lot at BCG about demand-led transition, which is until now the conversation has been, we're going to build solar panels, people will buy them. We'll build heat pumps, and you better buy it. And why should you buy it? Because it matters for the climate, and you should do, quote, do the right thing. And guess what? Nobody bought them. But you take state of Gujarat, 5% of the Indian population is in Gujarat. They have 67% of rooftop solar. Why? Government came, incentivized upfront capex spend, allowed Gujaratis to sell the excess power back to the grid, put in place some pretty reliable installers. So that kind of ecosystem lens to what are all the frictions that I need to get adoption, making it happen. And EVs, people aren't buying EVs except for the Indian women whose credit was being rejected because they're wiser, and we can all learn from Indian women. But EVs was not because people wanted to do right for the environment. It's because they believed they were going to drag race a 911 in a Tesla and win, or they were going to buy a Cybertruck and drag race a 911 while towing a 911. And by the way, how many Cybertrucks have actually done that drag race? None, right? Yeah. So it's all suburban dads and moms who are driving their kids to school and going to the GHOST train or going to the commuter train. So my point is, as you look at investment opportunities in terms of where you want to deploy capital, it's finding those areas where the ecosystem is coming together to make the economics work to drive the adoption. And so where I'm beginning to see green shoots of that is hydrogen, charging infrastructure, and EVs for sure. Carbon capture, I think, with the right policy support. And then I'm a huge fan of circular business models, where individual companies are finding ways to recycle, reuse, reduce what they're putting out in the world. There's a natural demand to that. There's natural economics around that. Waste to energy is a great example. So it's a little bit of that. But again, the lens is from technology to market adoption to pricing to offtake. Is it all in place to let capital flow? The issue, though, as you correctly pointed out, is that the economic equation makes far more sense in the developed markets than the developing ones, and so we need to work on that.
Well, but there's no infrastructure in place in some of the developing markets. You look at Southeast Asia, they've leapfrogged us in many cases because you don't have legacy infrastructure that you need to integrate it with. So you can mandate EV vehicles all you want. If you don't have the infrastructure and they're not affordable, how do you plan to achieve those goals?
Well, this is where the Chinese BYD is coming in, who also is not marketing. If you look at their marketing, I'm a huge fan of it. They're not marketing low carbon. My favorite ad is they drive this vehicle off a bunch of speed bumps while balancing a bunch of champagne flutes, and they do it with a Maybach and other very high luxury vehicles. By the way, no one in China is riding their car with champagne flutes floating on their hood, but that kind of marketing to generate mass appeal is what's driving the supply-led transition, the demand-led transition. But to your point, there's up to a limit, right? You can build charging infrastructure in a country like China, but then when you get to the broader EMs or the broader actual developing markets, it's not there, and so you can have the most demand.
And going back to your point on KPIs, that's why it's so important to not just look at the carbon aspect, right? Like of a technology, you really want to understand the social, economic, and environmental benefits above and beyond, because that is really only when it becomes successful. If it's actually bringing positive change to the community, it's reducing maybe energy dependency, therefore lowering your prices. Maybe it's creating a microgrid where there's additional social economic benefits for that. You're being more inclusive. Like you're bringing more than just the carbon mitigation or carbon removal with a technology or an initiative. It has to be holistic, and you have to be maximizing all the benefits of a technology or an initiative for it to be successful.
But that's how you pitch it, right? Those jobs you were talking about where the government was subsidizing for the solar panels, guess what? Those are high-skilled jobs. And the higher the pay, the more that goes back into the economy.
Employment opportunities.
It snowballs.
Huge.
That's how you close some of these, wealth and poverty gaps. I would imagine, I'm sure in emerging markets you would agree with that.
100%. And we talk about some of the sectors that are on the move, right? I mean, data centers and artificial intelligence and the energy associated with that, with data centers. I mean, we're working with a Southeast Asian company that's developed an immersion cooling technology that uses 50% of the energy of traditional immersion cooling, of traditional cooling data centers, and uses 1/12 of the space. So it's a cheaper alternative. You can unleash the power of AI more effectively and do it in a more sustainable way. So we're seeing examples of that all over emerging markets, and those are really attractive opportunities as well. So it's bringing all the factors to the table.
Yeah, I mean, we could go all day with this, but Mary Ellen, I'm going to give you the last word here. Is progress being made?
Oh, absolutely. No, really. And, in our business, we look at COVID as like one of the few silver linings. We got cell phones into the hands of hundreds of millions of people. Digital financial services just skyrocketed during that period of time, and that in turn has really led to a lot more risk mitigation and access to finance for adaptation and resilience.
Yeah, and guess what? That builds those micro local economies.
Exactly.
And we'll leave it on a positive note. Appreciate everyone's insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.